Welcome to all you advanced accounting learners, and I think there's a collective sigh of relief coming now that you can see Chapter 7 and you realize that, okay, we finally have put consolidations behind us, and regardless of the topic that we're going to get into, it's going to be a relief because you are finally finished talking about consolidated financial statements. And I realized Chapter 5 was probably the real toughie. When we had a comprehensive problem with upstream and downstream sales, we had a minority interest. We were several years beyond the initial consolidation date. So we kind of threw the kitchen sink into the problem on Chapter 5. And then Chapter 6 may have been a little bit of a relief because at least we're talking about statement of cash flows, which arguably in an intermediate accounting is a topic that most people struggle with. But I've found that statement of cash flows, once you've wrapped your mind around that, and I was around actually working as a CPA with Ernst & Whinney at the time when the pronouncement, I think it was FASB statement number 95, and I think they're up into the 160s right now, but way back then, we went from the statement of changes in financial position to the statement of cash flows. And I remember doing the research for one of my clients, and I was just a young CPA, just out of college, out of undergrad, and it seemed complicated, but it made sense to me. And the more I've worked with it, it just makes, I really do like statement of cash flows. And it's been around now. As you know, I think I've told you I've been out of undergrad for just about 30 years, and so it's been around a while and stood the test of time. And in consolidations, again, I'm talking Chapter 6, consolidations there, the statement of cash flows is not all that problematic. Now, we are going to mention it, or I will mention it, in the Chapter 8 lecture when we're talking about foreign exchange, and the foreign currencies they can wreak havoc on your statement of cash flows because obviously we're talking about cash, and so when you have those exchange rates going on, they can affect. It's what's called a line item on that statement as the effect on exchange rates on cash and cash equivalents. But again, I'll tell you in Chapter 8 the thing to do is to do that statement of cash flows in a local currency, and then you can do your translation after that. So let's leave that for Chapter 8, and I apologize for getting ahead of the game here, but on Chapter 7, so I got two pieces of good news for you. The first piece of good news is that we're not going to talk about consolidation, so you can all just crack open the champagne and celebrate there. The second piece of good news is this chapter is really, I'm going to present it on a theory base. Okay, we're not going to really crunch numbers. And if your eyes did not glaze over, and if you took less than 3 hours to read this chapter, then you are an extraordinary human being. Because even myself, it was really a grind to get through the reading on Chapter 7. So don't beat yourself up on that. And here's the other thing: I want you to get some foundational theory concepts. I want you to get a command of that, because that's what you'll be tested on in the CPA exam. And then if you ever find yourself face to face with this issue in practice, when either as you're working in public accounting, or maybe you get into a company and somehow you find yourself in the department and you have to deal with hedging and how to account for a hedge instrument and everything related to foreign currency. Well, what I would advise you to do, obviously, is get your textbook out, assuming that there hasn't been too much passage of time where the rules have changed since then, and get that back out and re-immerse yourself in it. And hopefully this structure, just the foundational theoretical structure that I'm going to give you, will come back, and then you can get into the bowels of the detail on how you're going to implement it in practice. Now, when I said hopefully the rules haven't changed that much, this is a fairly recent, some recent activity by the FASB to lay out these ground rules. And of course, we're going to talk about the delineation. There's really kind of a two different paths you can go down, whether you are hedging a cash flow, whether it's a cash flow hedge, or whether you're hedging a market value hedge. So, and we'll talk about that, and the slides do a good job of delineating between the two. So, all right, what are we up to here with foreign currency exchange? A little bit of history. I shouldn't say foreign currency exchange. It's really hedging the risk that comes to your business because of these floating foreign currency exchange. Now they're floating now, but prior to 1973, you had the gold standard. So maybe your parents or grandparents can remember that. It's a little bit of a history lesson, and basically, you talk about all the gold in Fort Knox. Well, that's the value of gold at the time, and that gold was backing up how much currency you could have in circulation. and so pretty much everything was going to be then pegged to that reserves of gold that the United States had. Now at this point, it's pretty much free market where you have just fluctuations between any given country's currency and how that would convert to the currency of another country. And so that's what we call independent float. So I just explained what that is. Now you can have situations where a currency of a country is pegged to another country's currency, and as you might guess, that is going to be the US dollar is going to be the benchmark to which they'll peg. And so basically they're trying to fix their currency in terms of that other country, and that's how that works. And I don't know if there's anything right now in the real world where this is occurring. The book did talk about a couple of instances in the past, and we're all familiar, I think, with the euro and the fact that the European system, and of course the talk a couple of years ago or maybe last year was with Greece possibly exiting the euro. And so the reason countries like that, the ones that are in it, I think like it, and of course the notable exception is England, is Great Britain. They chose not to jump into the euro action, but then the debt, each country's debt is denominated in euros, and so I mean because they got rid of their local currency. If it's Greece, it was a drachma, and they got rid of that, and so then it's now the medium of exchange is a euro, and so the value they place on their debt is in euros. And so between the countries within the European group, the euro group, there is no exchange system. They're all using the same currency. And I think the euro to the dollar, I mean, it obviously fluctuates, and it's I don't know, it's been sometimes 2 to 1. I'm going back maybe 10 years in my history. This came about in the early 2000s is when I think it was official. So that's what's going on there. Obviously here the exchange rate is the cost of one currency in terms of another. They're published daily. You can go research it or look at it anytime online. And the published rates are the wholesale rates that the banks will charge each other. So anyhow, then they talk about what the spread is. So all this stuff is pretty straightforward, just common knowledge really. But the book does a good job explaining it. What are we talking about on rates? The spot rate is the exchange rate, as the name implies. It's right now. It's on the spot. So what is that exchange rate that's available today? The forward rate is something that is an anticipated. You can lock it in today for an expected future transaction. So obviously there's going to be risk on that because when you get to that date in the future, the spot rate on that date may be different than the forward rate that you locked in. So it is a way to hedge that risk, but there's both upside and downside potential of that hedge. Now, I basically explained to you what a forward contract would be. Forward contract then is a requirement, keyword requires. It requires the purchase or the sale of a currency in the units at that future date at that contracted exchange rate. So, as I said, there is upside and downside potential depending on what that exchange rate is, what that spot rate will be on the date that you have to consummate and complete that forward contract. You're entering into the contract today, and so whatever date in the future, 30 days, 90 days, a year, whatever that is, there is a risk that that rate on that date is going to be different. But you're going to have to go through with this exchange that you entered into. And so both parties are really accepting both an upside and downside risk when they do that. The option contract. Now, options are something you can do in any financial instrument. We talk about it in the context of foreign currency exchanges, but you can have an option on common stock. You can have options on virtually anything. And there are two kinds of options, and I'll get into that here. You have a put option or a call option. And the way to think about a put option, and the book actually explains a put, but I always thought, from track and field in high school and the shot put. And so the person, the athlete is, they're putting this heavy ball, this shot. And so that's how I mentally have always thought of a put option is when I'm throwing something out, I'm getting rid of something. So in this case, it's a sale, okay? And a call option, which is the opposite of a put option, a call is being, you think of a nice pet dog or something, and you're calling it to you, and so you want it to, you're coming to you, so you're actually buying something in a call option. So hopefully that gives you a little mental model to memorize those terms. So a put option is I'm selling, or I'm going to put out into market something. And now what the option is, it is by the meaning of the word option, you are not required to do this. You're going to have the option to do it. It's going to be at your prerogative. And so then the rate that you're going to have at your prerogative is called the strike price. So you have an option to sell something in a put option arrangement. Now, you may not want to do that, and it may be stupid or counterintuitive to do that if that option happens to be underwater. And what am I talking about there? Well, if I have an option to sell something at $90, but the going market rate at that time that option is exercisable happens to be 100, well, it's counterintuitive, or it would not make any sense to sell it at 90 when I can just on the open market sell it at 100. That's what's called a put option that is underwater, and so it's basically out of the money. It's not doing me any good, but that doesn't matter because I bought the option with the intent of making sure I'm hedging risk. Now let me back up a minute on the risk that we're talking about here. If you sell, you're making whatever it is you make. Maybe you make shoes, and so you're going to then sell the shoes into this other country at some other currency's exchange rate. What you want to do as a company is say, I'm satisfied with my margin. I've got my sales price, I have my operating costs, and I have a margin. Sales minus operating costs is going to be your margin. And so that's how you're making money. Now, do you want to really be like a Vegas gambler and make money also on the currency exchange? And let's just go ahead and roll the dice, and hopefully that exchange rate's in a better position when I finally settle up the transaction. The answer is no. You're not in the business of gambling and trying to make money on exchange rates. You're in the business of making shoes, and what you do then is make money on that margin of your shoes. So that's the reason then we hedge that risk of the foreign currency exchange. Is we don't really care whether we're going to make much money or lose. We don't want to make much money. We don't want to lose much money. We just want to make money on our shoes that we sell. So that's the reason we talk about this stuff. So we talked about the put option, the call option, and how you can get a mental model on what the put is. It's for the sale, and the call is for the purchase. And again, the option is a right and not an obligation. So you need to get that memorized. I will test you on it. Foreign currency transactions is when a U.S. company buys or sells goods or services to a party in another country, and that's called foreign trade. And we're not going to get into economics here, but we have, when you have a foreign trade deficit, that's when we're importing more goods than we export. And so all that importing and exporting is going to bring up the issue of foreign currency exchange. The transaction is often denominated in the currency of the foreign party. So if a Chinese party wants to buy some of our goods, they're going to pay us in the Chinese currency. How do we account for the changes in the value of that foreign currency? Well, that's what this chapter is all about. GAAP requires a two-transaction perspective. The original account for the original sale is in U.S. dollars. That's what you're going to record on your books, on your ledger. And then the account for the gains or losses from the exchange rate fluctuations, those have to also hit your books. Now here's a case where an American company, they call it Americos, sells inventory to a German company for €1 million on credit. Well, being on credit, it means it's not a cash sale. They're going to pay us sometime in the future. In this case, it's 90 days. And they have a current rate of $1 US is €1.32. So what has to happen? The Americos ledger is in U.S. dollars, but it has a separate account for the receivable that's collected in the foreign currency. So what they're doing, they're designating that receivable, that asset, in euros. And you have to understand, they're going to keep that, the accounting system is going to keep that ledger in that foreign currency. And then the nice thing about sophisticated accounting system is a lot of this stuff is happening behind the scenes. It's not that you're going to have to account for every day, get out your spreadsheet, and then and do all these adjustments. The system is going to take care of that for you. And so you're going to have this receivable It's on your general ledger, but you're going to have this little side, carve out a piece of your relational database in your accounting system, and it will be carrying that at euros, even though when you do your reporting and your consolidation, if you will, is you're going to do it all in dollars. But over here, you've got that receivable sitting there saying, hey, I'm going to collect, based on today's rate when I created this asset of 1,320,000 of euros. Now, do you really think that you'll ultimately get exactly 1,320,000 in euros? Well, they're going to pay you what 1,320,000 is on the date that they pay you, which is 90 days hence. But look at what you've done. You've recorded a sale at that amount, and you're probably not going to get that in equivalent U.S. dollars. And that's where the risk is of a gain or loss on that foreign currency transaction. So the example here is because they're going to have to mark to market at the financial reporting date, which is December 31, and they're saying that there's our difference in exchange rate. Instead of $1.32, it's $1.33. So now I've got a foreign exchange gain because it's worth, that euros is worth more in converting to a dollar. So I've got $10,000. It changed by 1%. Excuse me, 0.01, because we had 1.32, now it's 1.33. And so when we increase the AR to the new value in dollars, we recognize a gain from that foreign currency exchange. Now, what happened when we finally settled up on March 1st? So 2 months in to 2014. Remember, this is a 90-day receivable. So we had, on our balance sheet date, we had a gain. But now look what happened. The rate fell to $1.30 or 1.3 euros to a dollar, and so now I'm going to have a $30,000 loss. I'm only going to receive in US dollars 1.3 million. And remember, the original sale was 1.32 million. So I had a $10,000 write-up of the receivable, and now I turn around. That was what happened in the first month in the month of December in 2013. Now I have a $30,000 loss that I have to put on my books for 2014, because when I do settle up, again in US dollars, I had originally 1.32 million. I wrote it up to 1.33 million, and now I'm only going to get 1.3 million. And so now you can see I've had to take that $30,000 hit as a loss in foreign currency exchange. Now, what if I didn't like that? What if that just didn't set well with me and I wanted to hedge that? And this is where we're talking about now a hedge instrument, where a company will seek to reduce the risk associated with that foreign currency fluctuation. Because you saw what it did to the financial statements. You have to mark to market on your balance sheet date, and when you get to the final settlement date, you may then go from what you thought was a gain for the first 10 days or first month of the year or whatever, and then now you've got this loss. So what if I don't want to have that fluctuation? And so what you're going to do is give up a portion of the potential gain to offset any possible losses. That's what hedging does for you. And so you'll enter into a potential transaction whose exposure is the opposite of the one that has the associated risk. So it's like for every action there's an equal and opposite reaction. There's a yin and a yang. So that's what we have to do here, is we're not wanting, if there is some kind of a positive adjustment or positive change in that exchange rate, I want to give up the potential of having that gain flow to me. I'll give up that potential by paying some money, okay, by incurring a bit of a loss, because those two will then offset each other. Now, the two kinds of derivatives that are used to do this hedging are a forward contract, which I think we mentioned that earlier in a slide, or an option, and typically it's a put option. The forward contract is going to lock you in to an amount. And what you're going to find is the difference between these forward contracts and the options is really the cost, because again, you're not wanting to participate in gains or losses relative to something that's not part of your core business. Your core business is not making money as a Vegas gambler on foreign currency exchange rates. Your core business is making shoes or widgets or whatever it is you make. So stick with the margin on that and hedge away the risk on the exchange. Now, the forward contract, as we said, is not a right, but it's an obligation to enter into that. And so, as you might expect, because somebody is going to be the counterparty to that contract, you're going to enter into it with them. Then, so both of you are saying, okay, I'm going to bet it's going to go this way. You're going to bet it's going to go the other way. But there's a because you're going to lock in that rate, and and transfer that risk to the counterparty that you're buying the contract from, and typically that may be a bank. So it's going to cost you some money. It's going to cost you more money than it will cost you if all you're doing is buying a put option or a call option, whichever. But if you're just buying an option, it's less of a cash outlay at the time you enter into that hedging engagement. Okay, in ASC Topic 815, this is Accounting Standards Codification, the guidance is given for 4 types of foreign exchange risk. And so in the textbook, they've listed the 4 here, but really the one that we talked about most often was a forecasted foreign currency denominated transaction. So that's where you have the receivable or the payable that is in a foreign currency. It's going to happen in the future, and so how do you hedge against the risk that's going on with that? And so there are other types of foreign exchange risk, and as I said, you can hedge against all kinds of risk, and not just the risk that arises from foreign currency exchange. Now, the fair value of the derivative is recorded at the same time as the transaction that you are hedging. So the earlier example in this slideshow was the German denominated account receivable. And so at the time, if you decide, okay, as a company, I don't want to live with the risk that's going to come from the exchange of that receivable, and say, okay, I'm going to live with whatever the rate is on the date that German company pays me the amount they owe me. And again, they're going to pay you 1.32 million euros, as I remember, and the exchange rate may have tanked or it may have gotten much better. And you say, you know what, I'm not willing to live with that, so I'm going to enter into a derivative transaction, and I'm going to hedge that risk by either doing a forward contract or buying a put option for that amount of currency. So what do? Well, if you enter into that hedge arrangement, you're going to record a fair value of that hedge on the same day that you record the receivable. Now, you may say, well, how do I know what the fair value of that hedge is? Well, if it's a forward contract, it's fairly easy because it's the amount you pay for that forward contract. And now you have this absolute firm commitment. And now, is that going to stay the same over time? Well, there may be, if the rates are favorable, then yes, there's going to be a gain associated with it because it's going to go to your favor, and because all you're saying is I will definitely enter into this arrangement. Now, if it's a put option, the fair value at the day you buy it is what you pay for it, and that option is going to fluctuate in value over time. And remember, I said it could actually be underwater, and so then it becomes out of the money, and there's no way that you would exercise it. So. But the good news about that option is you have just limited your upside potential, but you've also limited your downside potential. If it's underwater, then you're just flat out not going to exercise it, and you will live with whatever the rate was that you had. So anyway, the point is that you're going to make an entry for both events. You're going to make an entry for the receivable or payable that you have on your books, and you're also going to make an entry for the fair value of the hedge. And of course, then you're going to have some inputs into that, and the discount rate, you remember from finance class, should be your incremental borrowing rate. Some people say it ought to be your weighted average cost of capital, but this is what GAAP requires, is the incremental borrowing rate. And again, we're not going to get into all the mechanics of how that's calculated. That's really kind of beyond what I'm going to expect from you in this course, and especially given that I'm hitting you for the first time, or you're being hit for the first time with these concepts. Now, the 2 ways to account for the foreign currency hedge. This is important, and what I want you to do is focus on page 311 of your textbook. And you're either going to say it's a cash flow hedge or it's a fair value hedge. Now, the illustration in the book and the illustration in this slideshow about the German receivable, that could go either way. because you say, okay, is the value of that receivable changing, or are the cash flows that are associated with that receivable going to change? Well, you'd say, yeah, both are. I mean, both are one and the same, essentially. The thing about it, as I mentioned before in the PowerPoint slideshow, is that you can hedge any kind of risk that you want to. So you could have a block of gold bullion that you want to hedge against the changes in the value of that gold. Well, what do you think that is? Is that a fair value hedge or a cash flow hedge? Well, intuitively, your mind is going to go to fair value hedge because, I can't extract cash. I mean, I can sell the gold bullion, obviously, but there's some things that tend to be more fair value hedge, like maybe a work of art or something with intrinsic value versus a financial instrument. Like a receivable or payable. And of course, you can have a stock portfolio, the same kind of thing there, where it's a financial asset, and you say, okay, is it cash flow or fair value? So there are certain things that are going to say, almost like they say, that's a stupid question. I mean, it's both. But the issue is, as a company, you need to make a choice on whether it's cash flow or fair value, and it's your choice to make. Now, the thing is, on page 311, there are three conditions that need to be met, and they're saying you're going to call it either one, and it's going to have to be highly effective. What does that mean? Well, it means that it is going to succeed in offsetting the changes in the cash flows or the changes in fair value, whichever one you have elected to call it. And so you have to document and the documentation then is a third step, properly documented as a hedge. And you'll see in the textbook many times, matter of fact, I would say invariably, this equates to writing a memo to the file. And I work for a publicly traded company. Ernst & Young is our auditors, and we have done a interest swap agreement on our debt, and we have to say which one is it. Is it cash flow or fair value? And we have to document our statement to that effect and document why we think it's highly effective. And so they're not kidding you when they say that you have to properly document it. That is the case. Now, what's the big deal? Well, the thing that you need to realize is that on this accounting, whether you've gone fair value or you've gone cash flow, is the other comprehensive income issue. Okay, whether or not you're going to let the gain or loss that is happening as a result of that hedge instrument, and we're not talking about the gain or loss on the actual receivable itself, it's what you've done to hedge that and that instrument and the recording on that hedge. Are you going to flow the gain or loss to the other comprehensive income, which is a pseudo equity account? It's not flowing through your P&L. Or are you going to let that gain or loss on the hedge go immediately to net income? And it's net loss or net income, one of the two. And so there's a financial reporting risk, if you will. If you elect to go with a fair value hedge, get on the roller coaster and get ready to ride, because if it goes up, you're going to have a loss, or excuse me, a gain. If it goes down, you're going to have a loss. On the cash flow hedge, you don't care as much because it's not affecting your net income, not affecting earnings per share, therefore not having any impact on your stock price. So you're going to let the gain or loss flow through OCI. Other comprehensive income is a term you'll hear in practice all the time, and it's sitting over there parked in equity, and it's not going to show up on your income statement. So you'll see people try like heck to get everything, their hedge instruments, classified as a cash flow hedge and not so much a fair value hedge. So that's important. Now, the other thing to look at that I'm not going to show you, it's too busy on the slide deck, but if you look at pages 313 and 314 of your text, it's a wonderful tableau matrix, if you will, that shows both your forward contracts and put options and how you would do those either as a cash flow or fair value hedge. So it's very busy. It takes you through time from your initiation date, balance sheet date, and settlement date, but it's just an excellent two-page outline, if you will, on cash flow and fair value. And then also, drawing your attention to page 315, another delineation between cash flow and fair value hedges. Okay, if I have an option, remember the option is defined as a contract that allows you to exercise a predetermined rate if it's to your advantage. If it's not to your advantage, it's called an underwater option. It's out of the money, and you'll just let it poof, just vaporize into thin air. Now you paid money for that option when you entered into it, and so you're willing to pay that. And trust me, it's a smaller amount than if you had done a forward contract because there's less of a commitment on your part. And so it's money that you're giving up to whoever the counterparty was that sold that option. So again, there's somebody on the other side. It's like horse trading. There's a winner and a loser in every transaction. So they're saying, I want to take some of your money and I'll sell you this option to do it, and then I'm going to sit over here and I'll take that downside risk from you. And I'll guarantee you what they're going to do is they're going to hedge their risks. So nobody's stupid unless they're truly a Vegas gambler. So, and as with a forward contract, that option, whether it's a put option or call option, you're going to designate it either as cash flow or fair value, even though it could go either way. Well, what do you think most companies do? They're going to say, I'll take the cash flow hedge option because I don't want the volatility in my net income. Now, pricing of options, there's a little bit of calculus involved. It's called a Black-Scholes option pricing model. The Black-Scholes has been around since I was taking undergrad classes, so you can research it yourself. I can't even remember what school these guys were from, but they're using some pretty high-powered math, and the various inputs that go into the pricing of option, as you might expect. One input is time, the other input is volatility, and so I'm can't even hope to do it justice right now because I am not an expert on Black-Scholes. But I can tell you the accounting profession has always pointed to that model, and it has stood the test of time in your pricing. And that's how you determine what it's worth, because you're going to have to, one, record it on your books for the amount you pay for it, and as you go through time, that option is changing in value. Why? Because time is diminishing and you're getting closer to the exercise date. And what also is happening? Well, the exchange rate that you're trying to hedge is also changing, and there's volatility in that. So, and then obviously, if the thing's out of the money, and it's underwater, what do you think the option is worth? It's worth zero. So that's what you're doing here behind the scenes. Now, this slide tells you some of the things that you're doing to determine that value. And as I said, the current spot rate versus the strike price is one of the factors. Interest rates is a factor. Length of time is a factor. So that's basically what I've told you that go in as inputs to the Black-Scholes model. Now, fair values are determined by intrinsic value and time value, and we know that. It should be intuitively obvious as what's going on there. Foreign currency firm commitment hedge. The options are carried at fair value on the balance sheet of both the derivative financial instrument and the firm commitment. So the change in the value of the firm commitment, gain or loss, offset the gain or loss on the hedging instrument. Now, what is the firm commitment that we're talking about here? Well, that is the underlying receivable or payable that you're going to have to do. And if you have an option then for that amount to offset the exchange gain rate or loss, then you're going to recognize that in net income as the gain or loss of the firm commitment attributable to the hedge risk is changing. So again, one may be going up, the other may be going down, but that's the offset that's going on there. Cash flow hedge accounting. Again, most companies are wanting to designate something as a cash flow hedge as opposed to a fair value hedge, and it may be used for a foreign currency derivative associated with the forecasted foreign currency transaction. And as we said before, the reason companies love to use the cash flow hedge is because a gain or loss on that instrument goes to OCI and not through net income. So to summarize, a transaction may be denominated in currencies different from those used to keep accounting records. And you're like, okay, that's what I thought this entire chapter was about, and it is. So that's stating the obvious. The FASB has adopted a two-transaction approach, separating the actual sale or purchase transaction from the currency exchange speculation. Now, what does this mean? It means you've got the underlying payable or receivable going on, and so that's one entry you make on your books. The other thing you have, and this is a two-transaction approach, is you have to account for this hedge instrument that you have entered into, because it's got its own amount that you paid for it. It's got its own underlying value that's going to change over time. And of course, in a variety of hedging practices may be used to reduce that foreign exchange risk. And the two most popular are the forward, foreign currency options and the forward contract that you have. Okay, so what I want you to do, this is the end of the slideshow, but what I want you to do with your reading is not focus so much on the mechanics of the debits and credits. It's a good idea to look at the account that's being debited or credited and understand why that they're doing that debit or that credit to that account. But I'm not going to hold you accountable to doing these calculations. What I am going to hold you accountable for is knowing the theory, knowing this basic structure, this two transaction approach, and knowing then the difference between the cash flow hedge and fair value hedge. And really the critical thing is flowing those changes in value to OCI, which is what you do under a cash flow, or to under the fair value hedge accounting, you're taking it straight to net income. So hopefully this wasn't too fast, too busy, some of the most difficult reading you'll ever have, but it's one of those things that if you're ever facing it face to face in real life, you're going to just want to get out the book, have some quiet moments, and make sure then you've got it solidified in your mind what the proper debits and credits are to make. All right, thanks for your attention.